let's start off with that gold price, $1,440 a fine ounce, up once again. We had dismal news on the inflation front in the UK. We have a lot of signals that we could see an interest rate hike in the European Union. The UK perhaps sitting on the sidelines at this point in time. Tell us what's driving the gold price.
Yeah, I think there are three main things at the moment, of course, for gold. First of all, of course, political tensions within the Middle East and North Africa tending to encourage buying coming into gold. As you mentioned, rising inflation as well, I think, is a fairly critical factor. So inflation expectations in the US have been ticking steadily higher over the last few months. And of course, we've seen rising CPI figures for a lot of countries in Asia. So this, again, is very supportive for gold. So we do think it's quite a bullish story for gold at this point. We think the market will break higher in the weeks ahead, and from a technical perspective, we're looking for prices to move back up towards $1,600 an ounce at some point in the next month or two.
You know, Daniel, we keep hearing about the interest rate cycle, and when that turns, that will then result in a weaker gold price. The ECB, as I alluded to earlier, was talking about possible interest rate hikes down the line. Is that going to prompt selling in gold, or do you think that only when the US hikes rates will that then prompt some selling?
Yeah, I mean, that's a very good question. We tend to think that the rising rates will create significant headwinds for gold, but won't necessarily derail the rally. So at this point, we've got a very strong demand for gold out of places like China and India. And also we think we've got potentially a weaker dollar over the next year or two. So both these things are really important for helping to take gold prices higher. As you say, once rates start to rise, I think that will make things more difficult. But certainly I don't think it will rule out further upside for gold.
Any bearing in terms of what we're seeing coming through in Portugal, austerity measures, toppling over of Portugal's government if those austerity measures are not met with some kind of high demand from the people in the country? Are you concerned at all about the debt crisis in Europe, or do you think that's largely been priced into the overall underlying metal space?
Yeah, what we saw in the past was that as people started to really worry about Europe and the outlook for the euro, they tend to buy gold in very significant volumes. So I think you're right that Portugal is a potential problem for the next few weeks. And if we do see significant difficulties there, it's likely to be positive for gold as well as part of this geopolitical story. But having said that, I think the wider story is one of a macroeconomic improvement, and so we tend to think actually gold can do quite well through that as well as part of normal portfolio flows. So as people allocate more money to equities, they tend to put more money into gold at the same time as part of a kind of balanced portfolio. So we think the kind of improving macroeconomic picture will be the thing to focus in on rather than the immediate problems within Europe.
Taking a look at the geopolitical side of things as well, and the continued tension in the Middle East, the trouble that came through from Japan, we know what kind of effect it had on base metals. Initially, we saw a lot of pressure for platinum and palladium and other metals as well, and now we're seeing a bit of a rebound. Is this all based on the premise to rebuild Japan is going to result in higher demand for a lot of these metals?
Yeah, I think that's exactly right. I mean, what we saw in markets like Palladium is they fell very, very sharply once the auto plants in Japan started to close down. So that's a very kind of high leverage play really on the current Japanese situation. But what's happened is people have started to become a bit more confident as these plants have restarted. So a lot of the plants have started this week and are expected to start early next week. So people are becoming a bit more confident around that as these plants come back online. And second, as you say, the people are really looking through this current bout of softness and saying, well, this reconstruction is going to be particularly good for markets like copper and zinc and steel. All these things should benefit from reconstruction activity. So that's really been the key driver for now, and people have been overlooking the immediate problems in Japan and focusing on the longer run story.
Daniel, to what extent is the euro-dollar cross also having an impact on the overall commodity price space? I mean, we've got euro-dollar sitting at above 141.
Yeah, I mean, in terms of the dollar impact, I think it's pretty critical for most commodities, particularly for things like gold, of course. So normally you get an inverse correlation of around about 60% between gold and dollar euro. Of course, that relationship varies quite a lot over time, depending on, through periods of recession, often gold and the dollar rally together, so you get some positive correlation. But over time, the normal relationship is that weaker dollar will support higher gold and commodity prices, and we think that'll be the key thing to focus in on over the next few months and years. So dollar weakness should be supportive for the whole complex, we think.